Welcome to Epoch Report, where we look past the headlines at the structures underneath. Today, the Federal Reserve's shift under a new chair and what it means for global markets. We're examining the recent bond sell-off and the dollar's future, a topic that matters now as investors and governments watch for signals of a new policy era. The dialogue reveals a sharp divide. One side sees Chair Warsh's blunt style as a deliberate break from crisis-era habits, while the other dismisses it as mere personality. Key moments include the worst one-day bond rout since tariff shocks, the $40 trillion debt milestone, and a debate over whether abandoning forward guidance strengthens or fractures the system. The argument escalates from a single market move to a potential unraveling of faith in the dollar itself, with talk of competing currencies and fiscal dysfunction. So the question is Warsh's approach a disciplined correction or the start of a deeper erosion of trust? And what breaks first, the bond market or the dollar's dominance? Now, let us get into it. So here's the headline. Warsh's July remarks triggered the worst one-day sell-off in long-dated U.S. bonds since Trump's Liberation Day tariffs. That's a massive signal. Financial Times.
Okay, but a sell-off in bonds, isn't that just markets adjusting to a new Fed chair? Happens every time leadership changes, right?
Normally I'd agree, but this is different. Warsh's whole no spoon-feeding thing isn't just style. It's a deliberate break from the post-2008 playbook, where the Fed guided markets like a puppeteer.
But if that's true, why is everyone still treating this as a leadership transition story? The mainstream coverage is all personality, not policy.
Because the deeper story is uncomfortable. When the Fed stops guiding markets, it's admitting it no longer controls the narrative. And that's a massive credibility shift for the dollar itself.
Hold on. Isn't no guidance actually more credible? Let markets find their own clearing price instead of the Fed propping things up?
In theory, sure. But the entire global financial order since 2008 runs on Fed signaling. Treasury markets, foreign central banks, swap lines, they all depend on predictability. Take that away, and you get fragmentation.
So you're saying Warsh's approach is actively accelerating de-dollarization? That feels like a stretch from one bad bond day.
It's not just one day. Look at the backdrop. U.S. debt is projected to hit $40 trillion. When your fiscal position is that strained, you can't afford to lose market confidence. And Warsh is gambling with exactly that.
But here's the thing. The dollar's reserve status didn't collapse when the Fed tapered, hiked, or even during COVID chaos. What makes Warsh so different?
Because those moves were still within the framework. Warsh is pulling the rug on the framework itself. He's telling the world, don't expect us to save you. That's not a policy shift. It's an identity shift.
All right. But isn't there an argument that this forced discipline is exactly what the system needs? Spoon-feeding created moral hazard. Look at zombie companies surviving on cheap money.
That's the intellectual case, sure. But the geopolitical reality is different. When the Fed abandons guidance, it's not just disciplining U.S. markets. It's telling every nation holding dollars that the anchor is gone. China and Russia are already building alternatives. But those alternatives have been failing for years. The petrodollar, the euro, even gold. Nothing's actually displaced the greenback. Maybe this is all just noise. Here's the catch, though. You don't need a rival currency to break the dollar's dominance. You just need enough uncertainty. And Warsh's Jackson Hole speech is where that uncertainty gets its first big test.
So, what's your prediction? Markets panic, dollar collapses, world order ends? That seems like a lot of weight for one speech.
Not collapse, erosion. A slow, persistent stitching of the dollar's safety net. The speech won't end the dollar, but it'll mark the moment the world stopped assuming the Fed would always catch the fall.
I hear you, but I still think you're over-indexing on rhetoric. Actions matter, and unless Warsh actually abandons the balance sheet or rate policy, this is just a different tone, not a different system.
Tone is policy.
When the most powerful central bank in history says, we won't hold your hand, that's a structural change. And the $40 trillion debt number just makes it worse.
Maybe. But I'd argue the real unraveling is fiscal, not monetary. Congress doesn't want to tax or cut, and Warsh is just the messenger catching blame for a debt problem no Fed can fix.
That's actually a fair point. And it's part of the same story. The Fed's retreat is a mirror of Washington's dysfunction. When the fiscal authority won't act, the monetary authority's silence becomes deafening.
So, in a way, we're saying the same thing, just with different villains. You blame Warsh, I blame the system. Either way, the dollar's status isn't eternal.
Exactly. And that's the takeaway. This Jackson Hole moment isn't about a man. It's about the end of an era. The question isn't whether the order fragments, it's how messy it gets.
I'll concede this much. The uncertainty is real, but I'd bet on adaptability over doom. Markets have a way of finding a new equilibrium, even without a gentle Fed hand.
Maybe. But every adaptation creates friction. And friction in a $40 trillion debt world is what turns market wobbles into structural cracks. We'll see who's right come Monday. Finally, on the dollar's fate, the conversation lands on a shared warning. Whether it's Warsh's bluntness or the system's fragility, the era of automatic Fed support is over. The substantive conclusion is that the bond sell-off and the debt load aren't isolated. They're symptoms of a fractured consensus, and the dollar's status now depends on how much uncertainty the market can absorb. That is all for this episode. Thank you for watching. I hope you found it worth your time. Subscribe and turn on notifications so you do not miss the next one. Leave a comment below with where you think this goes. See you next time.